And yesterday turned out to be a little bit of a reprieve. Can't really say that we are out of the woods just yet because the jagged edges definitely did test your patience and definitely kept you on the tenterhook. So we started off smidge in the green, lost a little bit, recovered a little bit, and finally managed to eke out a good gain, about 0.5% off an uptick. Of course, that last hour pull-up was thanks to HDFC Bank because that came out with its numbers, reacted positively and pulled the index up with it. But other than that, yesterday the dominant trade was clearly technology all the way. All your 5 top movers were largely from within the IT pack. What with the move on Wipro, Infosys, TCS, all of those counters held out quite smartly. But again, you're not really seeing a meaningful comeback, Nikunj. And looking at the market breadth, that continued to reel under pressure.
So two parallel markets, Aisha. The Nifty frankly did nothing special, but it did not fall. Yeah. The market breadth is where the acute pain actually has started. Let's talk about the Nifty first, and I think the Nifty clearly seems to be making a base. Is that a temporary base or it's a base something which will remain durable? As of now, it's difficult to ascertain. But the only silver lining or the relief for the market right now seems to be that Nifty from last 8 days now, between 2300 to about 23,700 seems to be certainly hugging on to a line, which makes you slightly more optimistic about the scenario. Not 24 December, 7 days please. 7 days is where the Nifty seems to be making a base. Second, the selling in mid and small cap stocks, rank mid cap stocks, I think is very brutal. It started with decimation of volumes in FNO stocks, then came some of those, the Vodafones and the Yes Banks of the world, the stocks which are dominated by retail traders, they got decimated. And now the ultra HNI and HNI names, whether it is in solar, whether it is in manufacturing, whether it is in capital goods, all those stocks in a sense have got completely, they've come on the butcher block per se. The market lacks any kind of a momentum. The desire to buy is missing. The desire to commit capital, I think, seems to be missing. So we are going through what could be called as a painful adjustment. Nobody is surprised that it has come, but everybody certainly is surprised with the intensity. The problem with selling and the market grind, Aisha, is that when it comes, nobody likes it. And when stock prices go higher, everybody expects they will go higher. So the market mood has changed. The market has reminded all of us that, look, what makes market unique is that there is up and there is bad, there is volatility and there are flat moves. Right now we are going through volatility and through this painful grind, and I think this may well continue, Aisha. So we'll have to approach the market differently. We'll talk about it, that what are the 4-5 things which could change. But you look at the market from the prism of Nifty, that gives you a glimmer of hope. You look at the market from the prism of small and mid cap stocks, this market will look dangerous.
Yeah, absolutely, because one is continuing to see a churn in their portfolios and real under pressure. And also what's really coming out as a stark factor is the kind of disconnect that we're having with the US markets or the developed markets. Look at Wall Street, that's managed to extend its gains for another day. S&P 500 is testing its life highs once again. Very upbeat earnings, and that's clearly supporting the moves on Wall Street. Crude oil inventories, they've increased according to the API data. The stock has risen for the first time about almost in 5 weeks. Netflix surged on account of record-breaking subscriber additions. You had AI, software stocks, all of them upbeat on Trump's announcements of a more inward-looking economy and more allocation. The dollar index, that's managed to hover around that 108.1 mark amid the tariff uncertainty, and the 10-year yield has also steadied around that 4.57% mark. So that's pretty much the global picture. It's been pretty healthy all across, and the disconnect clearly continues. What about Asia? Even markets like Shanghai, look at the way it's spurred up in trade today, much unlike yesterday when that 10% tariff implementation from Feb 1st got announced. It's a solid 1.5% move that you're seeing for China. Hong Kong also holding up marginally in the green, and that's pretty much the case with Japan, which has been very, very steady indeed. So it seems like it's a very India isolated case. At least it seems like that for now.
So India was the performing market. The flows which we are looking at it's not that emerging market flows are great anywhere else. I mean, China was supposed to be this comeback trade that has failed. Yeah. Korea has got their own set of problems. So it's not that emerging markets are doing anything special, and it's only India problem which is getting magnified. But yes, I mean, India was the performing market. India is a liquid market. Indian market, I think, are the only unique market where FI is selling and DI buying. So the seller is not thinking about breaking the prices down, and then you have a currency interplay. So everything is coming together. And now it's getting increasingly evident that in the near term, for institutional investors, why they are selling, and it's getting increasingly difficult to predict how long they would sell. Nobody had anticipated this kind of selling or this kind of a comeback. Frankly, if you think about it, Aisha, last 10 days the dollar has not gone from 107 to 113 or 14. The yields have not gone from 4.5 to some 5.5, but the selling continues. So I think it's pure capital allocation which is moving. Flow continues to gravitate towards US economy. The long dedicated funds which always loved India, suddenly they are taking it on the back seat. So this FI selling, I think, is the real deal. You'll have to just deal with it. So what happens in this kind of a market, and we were talking about it, which is that what happens in this kind of a market where markets are going through this transition phase. First, high PE stocks will start underperforming. I think it's evident in the way how stocks which are trading at P multiples of 40, 50, 60, 70, little bit of slip here and there. We saw what happened to, let's say, DMart. We've seen what happened to Dixon. So that, I think, is one, that high P stocks, they will get completely crunched. Second, what will happen in this kind of a market, Aisha, is that the store of underperformers of value stocks, they will start coming back, which is suddenly you're seeing outperformance in a Reliance, HDFC Bank, the store of the value, starts migrating. That's how market leadership migrates. Third, IPOs, hello. Not heard any new big IPO because that is taking a backseat. And then SME and mid-cap stocks, they really start, they really become from the front bencher to the back bencher. So these are three trends, I think, which are visible. High PE stocks will come under pressure. Store of value will move to underperforming large cap stocks, and I think IPO and SME stocks, or that action, will suddenly take a backseat. So that's how the market seems to be progressing right now. Yeah. I'm surprised this time there is no pre-budget rally. I'm surprised this time there is no budget talk. I'm surprised this time around there is no assumption, speculation or commitment.
Well, there is. We are picking up that the budget this time around is not going to tamper at all with capital market gains. It's going to remain status quo, and there are going to be no structural changes to either long-term or the short-term capital tax regime. And, all the rumors that were doing the rounds, we've completely rubbished them with our exclusive news break yesterday.
It was a good story break, right? And I think it helped the market mood yesterday. So that's the impact of ET now. I would love to say that. So let's understand, Aisha, what the news is. Yesterday we were discussing that, look, this is a rumor in the market, and then, Prakash put, motion into action. And then we were able to understand that the speculation in the market actually was completely speculative, and it was rubbish, if I may use the word. So what was the speculation in the market? The speculation in the market is that a new tax framework is coming. Yes, we've broken that story. But the speculation in the market was that as per the new framework in the market, the tax slab which you will get from small STCG or LTCG would be applicable as per your tax slab, which is that if you're
taxed 30%, God help you, LTCG can't be 30%.
It cannot be 30%. Yeah. But markets are markets. When nervousness comes out, people and markets, they tend to speculate. That's one.
I mean, it was just panic in an oversold market. The kind of manic that was playing out day before. Just any rumor shook the market.
The social media panic was at play. This was like, today's Thursday, right? This all happened on Tuesday. Okay, so there is no change. Capital gains tax will stand as a different identity. So the policy is not going to change. The process of tax implementation would be made easier. But more importantly, Prakash has also learned that the tax rates for LTCG and STCG will not be changed, which is very important. Which is that last time in the budget, the tax rates were increased, and now they are unlikely to be revisited. So two important factors here. Number one, no change in the capital gains, and no change in the rate of LTCG and STCG. So if at all that was causing the panic in the small cap stocks, which I think it did at least on Tuesday and early part of Wednesday. So that in a sense is an important clarification. So this is something which is crucial, important, and our viewers should take note of it, that the TDS process will be simplified. The Income Tax Act could be altered, but the policy will not be changed, the process will be altered.
If you like this video, then like, share and subscribe to ET Now.